Lieutenant Governor Ravitch for sharing those stories and giving us a real sense of the sort of history of all these events that have occurred. Now, I'm Rick Mattoon. I'm with the Federal Reserve Bank of Chicago, and I have to admit that when I saw the topic of stress testing, I was pretty much, well, you had me at stress testing, right, for what type of panel I wanted to moderate. So this is right in my wheelhouse. So we have a really distinguished group here. And one thing I also want to sort of weave in is some of my own personal experience. And this goes to this issue of, like, how do you make something like going through a mechanism like stress testing necessarily something that policymakers have to actually act on, that it actually becomes part of the culture of the organization? And one of the things that I have to say is at one point in my life, I actually worked for the governor of Washington. And this was in 1999. And we actually did a stress test to try to figure out what should be the proper size of a rainy day fund budget. And what we ended up with was a significantly larger number than we currently were saving at that time. But I remember the discussion we had was, he said, well, the problem with this is he said, I can't approve this level of savings, because he says people are going to say either we're sort of confiscating money out of taxpayers' pockets by holding this money in a side, or we're not spending on necessary programs. And he said, so I recognize that we have this volatility, but the only way I could do this is if you actually sort of forced my hand, and I had to. And this was a fairly intelligent and very fiscally responsible governor. So I think it shows sort of the political dynamic you have to take into consideration along with the technical part. We have an absolute fabulous panel here. So starting at the very end, we have Don Boyd, who is a twofer on this one. So we managed to get a discount. So we got Don for two programs. Don, as has already been explained, is with the Lincoln Land Institute, plus many people know him from his days at the Rockefeller Institute in New York. He's had numerous exposure with the Volcker Alliance, and I think is considered one of the premier people in state and local government finance. We have Greg Minnis, and Greg did a really interesting project. He had a Kennedy School working paper, which looked specifically at pension funding and broke into a variety of different states, different buckets, which I assume you'll probably talk about, and sort of how you would stress test pension funds to sort of understand the dynamics behind them. Then we have Josh McGee, who is with the Laura and John Arnold Foundation. As you know, one of the things that this foundation is particularly interested in is looking at sort of improving government operations and efficiencies. And they've funded an innumerable number of studies throughout the United States, academic and otherwise, to sort of look at all sorts of aspects of sort of increasing sort of fiscal performance and sort of more transparency in terms of operations. And then last but not least is Chris Meyer, who joins us from Loop Capital. Chris is a local guy, a Chicago guy, but he's a muni bond expert and a fiscal analysis expert, and really gives you a perspective of sort of like what the market thinks of these sorts of mechanisms. So without further ado, I'm going to turn it over to Don to kick us off. And again, since he's a twofer, we get you on the cheap. So take it away, Don.
I think I'm just going to say a few things, not too long. So one is this? Well, the title includes revenue in stress testing,
yes,
right?
Right. It's everything from rainy day funds to pension funds.
All right. So first of all, these are very different kinds of stresses. You know, with a revenue volatility or revenue stress, it happens quickly. If you're lucky, it gets kind of resolved quickly, as in it may bounce back fairly quickly, and it has rapid budgetary impact. That's very different from pensions. Pension, it happens quickly, and in fact can be far deeper, much bigger than the revenue shortfall. One of the problems is it has very little near-term budgetary impact, so politicians are cushioned from it. And as to whether it bounces back, I think there's more of an open question there in terms of what you ought to be thinking about it. Next thing I want to say is that I think there are some lessons from the work that my colleagues and I have done on pensions. And with regard to pensions in particular, I would say that one of the reasons pension stress testing is so important is because the incentives and institutions related to pensions are so deeply flawed. So incentives are bad because pensions tend to be drastically underfunded, and the annual expenses of securely funding pensions are drastically understated. The institutions are bad in that, unlike the private sector, there's very little or no requirement to actually pay into the funds. And we've seen that in Illinois, New Jersey, and elsewhere. In part because we have such deeply flawed incentives in institutions, we'd love to fix them. That's probably not happening in the near term. All the more important reason to have daylight on the problem. A couple of quick conclusions from our work. One is that the risks are far greater than they are in the past for two main reasons. One is stocks, and the other is size. That is, governments are far more into, or pension plans are far more into stocks than before, and they're far bigger than they were relative to budgets. So the risks are far greater. 3 times by a measure we use than, say, relative to 20 years ago. Second, even when long-run assumptions are reasonable, as in based reasonably, the risks that plans are taking create enormous political risks. Even if you would hit 7.5% on average over 30 years, you might find that because of the volatile investments, contributions have to go up 50% sometime over that period. Will the politicians accept that? The plan might have to be deeply overfunded, significantly overfunded for some period of time, and you've got to count on politicians to not want to tap that, or it could become deeply and seriously underfunded. Third thing from our work is that these risks are correlated with government finances. That is, that bad economic environments may drive bad investment returns and bad tax revenue. And so the political stress becomes all the greater because it's even bigger relative to the size of the budget. So I think all those things lead me to conclude that stress testing is important. It's hardly the solution, but it is an important part of shedding light on the problem and maybe pushing political behavior slightly in a better direction.
Great.
Greg?
Thanks, Don. In my remarks, I'm going to echo some of the points that Don made and explain why we think that public sector retirement systems and state budgets are more vulnerable than they've ever been to the next recession. Then I'll describe some of the findings of our research, provide specific examples, and touch on some of the implementation issues that you mentioned, Rick. And then lastly, I wanted to discuss a little bit about our observations on California, which I think is an incredibly important case, not just because some of the legal issues that are being considered, but how that might play out in a recession scenario, given how much budget pressure there is already on state governments and school districts in that state. But before I do that, I wanted to reinforce some of the comments Dick Ravitch was discussing earlier, talking about the voice of experience, and share a little bit of a conversation a few of us had last night, stepping away from the financial models we all know and love and describing some of our personal experiences. For me, I've had the impeccable sense of timing of entering the job market in 1991 when the real estate market crashed. I was the CFO of a tech company in 2001 and 2 during the dot-com implosion. I worked at a bank in 2008 and 9. And just to complete the round trip, I then went to state government to deal with the aftermath in 2010 and 11. So I realize my wife is right when she talks about my sense of timing. But at the same time, my experiences looking back in the 70s and thinking about high inflation and stagflation scenarios, and the person for whom this conference is named really comes to mind, as well as people like Dick Ravitch. My memories are limited to long gas lines and a T-shirt I wore at the beach that said "Property of Watergate" when I was 5 years old. So that just reminds us how important these conversations are, and how important it is to absorb the experience of people like Mr. Ravitch and really thinking through these issues on both the numbers and the people behind the numbers. Turning our attention to the state on public pension systems, we really look at 4 indicators which explain that after 9 years of economic recovery and stock market gains, these systems and in turn government budgets are as vulnerable as they've ever been. First, we look at the ratio of publicly reported pension debt to U.S. GDP. That was around 2% in 2007. That ratio spiked up to about 11% in 2008 and 9. And the most recent numbers have it pegged somewhere about 9%. In other words, things have stabilized, but there's really been no meaningful recovery in overall state pension balance sheets. The second thing we look at is exposure to financial market volatility, where the implied equity risk premium, the difference between the average assumed rate of return, which today is about 7.4%, and where the long bond is trading, is still at or around historical highs, some number north of 4%. And indeed, to Don's point, if you look at the typical pension portfolio, 50% in stocks, a quarter in alternatives, a quarter in bonds, the portfolios have recently and will continue to move up and down with the financial markets. The third thing we study is the budget pressure historically. Pension costs since the beginning of the 2000s has more than doubled as a share of state and local own source revenue. That number has gone from about 3% to 6%. By itself, that's not a dramatic number, but obviously in states like New Jersey, Illinois, Kentucky, and Connecticut, it's had a substantial impact on spending across the board. And the last one is more demographic, where we study the impact of baby boomers retiring and the substantial increase in benefit payment outflows. This is something that's not typically captured in most actuarial reports. But again, since the beginning of the 2000s, the net outflow number, the difference between money going out and money coming in, has increased from about 47 billion to almost 110 billion. And in certain cases, that's actually applying pressure on state funds' ability to follow their investment policies. So taking all those pieces together, I think it's fair to say that in aggregate, this exposure has never been greater. At the same time, I would hasten to add that the disparity between the well-funded states that have continually paid their bills or put in place good risk management policies, and the difference between some of the states that are more fiscally challenged has never been greater. The 7 best funded states have been funded at between 95 and 100% for the last 15 years. On the other side of the coin, the 7 worst states have gone from about 90 to 65 and now at only 50% funded. So I think really understanding just how different the affairs have become between those states is really important. So where stress testing comes into play is that it allows you to examine the issues that are most important for each state, and to do critical analysis that draws from experience, that applies different economic scenarios that we've seen in the past, and really develop a better understanding of what the impacts could be on government budgets. The report that Rick mentioned, we dug really deep into 10 states. I should thank Brian Septon, who is the actuary from the Terry Group that worked closely with on this. And I'll just give 2 examples. So if you look at the state of New Jersey, and a pretty simple but not unrealistic scenario where investment returns are only 5%, and the state does not follow through on its recent commitment to raise contributions, but only increases them a little bit each year with revenue growth, in other words, a fixed percentage of budget. This is not an unrealistic scenario for New Jersey, and we forecast state pension system insolvency in 12 to 15 years. And there's a handful of other states that are in a similar position, and that's much different than it's been in the past. On the total opposite end of the spectrum, the analysis that we look at the state of Wisconsin, which has a very sophisticated, what we would call risk-managed defined benefit pension plan, is really impressive. And most any scenario you can throw at the state through a set of adjustments to contributions and also post-retirement benefits, there's a relatively stable sense of fiscal position and costs. So I think in each case, a standard approach that looks at similar scenarios and techniques can really help highlight what the issues are for each of the states. And then I think, Rick, on your point about implementation, I would say 2 things that as to why I feel stress testing for public pensions is the area where we actually have the most information to prepare and think through how to deal with economic uncertainty. The first is something of a technical one. The Actuarial Standards Board came out with guidance in 2017 around pension risk reporting. It's not a requirement, but I think it is a very exceptionally well thought out, detailed level of guidance that really gives policymakers and experts a set of rules and a menu of options to choose from. That's a really big deal. I think up until now, almost every conversation in terms of actuarial standards has focused on why a certain set of best expectation assumptions are the right way to go. This is the first time that we've moved away from that. And then the second thing I would say is, as people who are close to this issue know, if there is another economic crisis or a downturn, how things are going to play out from a policy perspective, the first couple steps are actually reasonably easy to predict. The reason for that is most states follow what I would describe as a pro-cyclical funding policy that has the effect of causing budget cuts or maybe requiring more revenue because the policy calls for more contributions at exactly the wrong time. I would argue that's a flaw in the system that needs to be fixed. But Chris Meyer and I, speaking of experience, were talking about back in 2010 just how valuable I found the Loop Capital reports because they were keeping track of the manner in which states were specifically responding, really by lengthening their amortization periods. And so my point there is that the question is going to get called in a very specific way, state by state. The bond rating agencies are going to pay close example to those that make good decisions versus bad ones. But we also have the tools to prepare for this. So I think it's really something that, based on our research, we feel every single state should be adopting. And there's a lot of momentum in that area. I mentioned California because, as many might be familiar, the so-called California rule, which in simple terms suggests that pension benefits are protected for workers the day they enter public service, is something that's actually being considered in the courts in the state. That's a big deal because a dozen other states essentially point to the California rule and follow similar policies and practices. I'm thankful not to be a lawyer. I'm not going to handicap this or comment on the nuances of it, but suffice to say it's a really big deal. But what I think makes California especially interesting when thinking about that lane of policy discussion is just how much pressure there is currently on the local governments and school districts in the state. And that's based on the current state of affairs. So in a downturn scenario, I think that in many instances, given the rigid rules that California follows for making contributions, that's going to be unaffordable. So if it's the case that we see a recession in the next couple of years, and the legal framework in the state that many others also follow happens at the same time and those two paths cross, I think that's going to be a substantial development that could have impacts across the board. And here again, we've done some stress testing analysis on the state, and it's the reason that I point out the localities in terms of their level of exposure. So overall, I think to Don's point, this is a very vulnerable time for state governments. 5 states have adopted stress testing since 2017. I think the field is ripe for a standard framework, and we can be much better prepared for the next recession. And hopefully we'll have the wisdom to make the right decisions when it comes.
Thanks, Greg. Josh, you want to take away?
Yeah, fantastic. So I agree with everything they just said. So let's just take that as a given. So I want to make more the case for why stress testing is important. They made a little bit of the case, but I think it's a pretty strong case. And then talk about what stress testing is. We often use that word as a shortcut and don't actually describe what it is. So first of all, I think the case is pretty simple. These pension plans have high leverage on taxpayer resources. So if you look at just the total liabilities relative to GDP, in 1990 it was around 10% of GDP. Today it's 30%. So not only has debt grown, but just the size of the promises that we've made to public workers have grown substantially relative to our resources. And that means that the call on taxpayer resources is just much bigger today and is harder to manage. In addition to that, we've seen a huge shift to greater investment risk and less liquidity. And this means that on those promises that were being made, we're just taking much bigger bets, making much bigger bets in the market than we were in the past. In addition, governments since around 2000 have adopted funding policies that instead of making up the gap on unfunded liabilities are just treading water. So after the dot-com bust, going into 2008 was a time of expansion. And yet we saw that pension plans didn't make much headway on their unfunded liabilities, and that's because government resources were not flowing into those plans at a rate that would actually close that gap. They were just treading water. After 2008, Greg mentioned this, the unfunded liabilities haven't come down. They've just kind of remained flat. Governments have been paying in such a way to maintain their current levels of debt owed to these systems. That leaves us very vulnerable to a ratcheting effect where the next downturn is just going to ratchet up the unfunded liabilities and the fiscal pressure. The result of this has been a crowd out of other things that we actually care about. So we've all kind of watched the teacher strikes happen in Oklahoma and Arizona and West Virginia, in Kentucky. There's a reason that public workers are upset. It's not necessarily their pensions, it's that their salaries have been flat for a long time. The number of workers that look like them have been declining. Their job conditions have gotten worse because we haven't been maintaining buildings, we haven't been paying for school supplies. And a big cause of that is because more and more of our resources are going to pay down debt into the pension system. So if you look at across the board today, around 70% of the government contributions going into public pension systems is going to retire debt and not for new benefits earned by current workers. That means a lot of the resources that we're putting into these systems, a lot of the increase in cost is not because we've got overly generous benefits, it's because we failed to pay for our promises in the past. And that's a big problem. And I would argue that why stress testing is important is because we've got a problem with decision making. So we haven't paid for our promises. There are a lot of factors that have led to that. These are complex systems. And it's the decision-making process that has allowed governments to obfuscate their responsibility to adequately pay for pension promises and is leading to these big consequences and leaves us very vulnerable going forward. And so that's the case that I would make for stress testing. And I'll close with, what is stress testing? Often we think about stress testing as we've got the banks have problems and we've got to make sure they've got enough cash on hand for the big disaster. So we often think about stress testing as testing against the big negative black swan event that may hit us. I actually think that stress testing, the value in stress testing is much more mundane. It's actually just having the plans and their government sponsors look at the future and consider even moderate downside scenarios. What happens if instead of getting 7.5, I get 7? And what am I actually going to do about that? So stress testing is not an exercise where we're looking at the black swan event. The black swan event gives people comfort that it's unlikely to happen. This is the mundane event that could actually sink the ship, and we're not looking at it in a lot of places. There's a lot of credit that goes to Greg and Pew and Don Boyd that have been really raising the alarm bells around this and pushing for states to adopt these practices to improve decision making.
Thanks, Josh. Thanks very much. And last but certainly not least, Chris.
Thanks, Rick. I appreciate it. Thanks to Greg for the nice compliment.
Shout out.
I appreciate that for our work. What we've heard from the panelists so far is unanimity in terms of the vulnerability of the system from a pension standpoint, universal need for stress testing. I'm not going to disagree with any of that, but I want to sort of take you through a short thought process on this and a little bit from maybe the market side of things. I work for a broker-dealer. On the sell side, I represent and interact with a lot of investors as well as other broker-dealers. And so the flavor is a little bit different, although the one thing I assure you is almost any buy-side analyst will favor stress testing without a doubt. So that is very clear. But, the focus, I think, you read a lot of the literature. What are people looking at? They're talking about adequacy, intergenerational equity, cost stability, predictability of cash flows and payment streams, and the importance of connecting the pension liability with the state resources to pay for it. And is there a match there? Is there a linkage there? And can the state stand up to increasing burdens that they get from their own pension side? I was with a group of people at lunch. One of them was a rating agency that hosted us. And I said, what are you hearing about stress testing at the state level? Is this a big deal for you guys? And, how many states are involved in this? And they looked at each other and they just kind of shrugged their shoulders and said, we don't know much about it, And by that I infer, and I think Greg kind of validated this, is that it's in its infancy at this point in time. Stress testing of pensions, there's only 5 or 6 states that by law are required to do it. I'll be talking about Virginia, which is one of them. And so it's just starting out. So there's no uniformity in terms of what are the metrics, what are the types of things that people should be looking at, or should they in fact be different for each state? It'd be nice to have some comparability to be able to look at the stress test of New Jersey and compare it to Illinois. I think we'd do better than those guys, but who knows? You don't know if it's the type of thing that should be unique to each state, and I think that's unclear as of this point. GASB, the rating agency's response was, GASB doesn't require it, which is true. It's not required. You don't have to do it. It's done by a very limited number. And the key is there's, even amongst the ones that do it, so far as I know, there's, and Greg may have to correct me, there's very little linkage between the results of the stress test and the General Assembly or the legislature and the people who vote on budgets and funding pensions. And that is really the key, is because to make it work, to make it beneficial for all of us, you got to have the linkage. You got to have something that compels the legislature to look at and at least consider seriously corrective measures. In terms of what's looked at, I think Josh covered some of this, risk of insolvency, payments becoming unaffordable, but it really boils down to, in this inordinately complex system that is a public pension, declining asset levels, asset depletion, and transition against your will or better judgment to a pay-go system, and therefore threats to sustainability. So you can sort of describe that somewhat differently depending on your perspective, but I think in a large measure that's what it comes down to. And people are looking at things like total contributions to the payroll, employer contribution as a percentage of own source revenue, which again is that linkage to the state side. The sequence of investment returns, which is key, and the shortfall, obviously. So, we get back to what we've been looking at for quite a long time in the muni bond market. In the bond market, investors look at funded ratios and they look at contribution levels. And where we've gone with that is to develop a higher level of concern over the last few years over the level of the funded ratio and how fast it's dropping, and maybe from what level. Is it at 40% or is it at 70%? And the contribution levels, are they escalating rapidly? Are they above certain levels of payroll? These are the key new avenues that are important. We look at some balance sheet indicators, the discount rate and sensitivity, asset volatility ratios. Again, how important each one of these relative to the other is as of yet unclear. I'll quickly kind of summarize where Virginia is at so far as I know. They have an annual requirement to present data to the General Assembly that represents, in their view, risk management or sensitivity analysis. Historically, the General Assembly has paid the annual required contribution roughly 2 to 3 times out of the last 20 plus years. That has not changed since the sensitivity analysis was enacted in 2017. They expanded their benefits in 2002, right at the peak of the market. Not the only state to do that. They made changes in their investment assumption as well. And they had adjustments due to unexpected plan experience, which, as we all know, can mean a variety of things. So I think the importance of education across the board is highlighted by these 4 things by themselves, because the timing, clearly, it was off in a number of these policy decisions. So here's what a municipal bond analyst is likely to say. There's a couple in the crowd. They can throw apples at me if I'm wrong. But I think they would feel, yes, we want stress testing. We believe in stress testing. But if you are not going to pay 100% of your ARC, if you're going to change your plan parameters, and make them more expensive and not fund that, if you're going to reduce your investment return assumption at irregular and ill-considered times, even though they should go down, and you're not going to pay cover your full liability. What is the point? Your biggest risk is yourself. Your biggest risk is your own governance. As much as the stock market can kill you, as it did in the Great Recession, if you look at even states like Illinois, if they had not taken 3 pension holidays, they would be a lot better off in terms of their funded ratio. So I think the practitioner very much favors, to sum up, the sensitivity tests, but feels like, wait a minute, we need a level of responsibility and adult behavior first in terms of the management of the basic responsibility.
Great. Thanks, Chris. Thanks, panel, very much. Those were great comments. So I'll start with a mundane question, which is other than for the good graces of Pew and Don Boyd, who should actually carry out these stress tests? I mean, if you're going to try to make this part of a government operation or part of a structure for government decision-making, whose responsibility should that be to see that these take place? I'll throw it to anybody. So.
Well, so we've seen in a lot of states they have an entity that is responsible for scoring budget items, that does analysis. I think one thing is clear to me, that it would be great if the pension plan did this on an annual basis, if they did stress testing. In the broader context, they probably don't have the tools to do anything other than just the pension analysis. And so there needs to be some responsibility allocated to their normal entity that does this, whether that's an OMB type entity or some other that is required to take the analysis that comes from the pension plan and puts it in the context of the budget. I'll say that, when we talk about stress testing, it's also very important that the bounds of the analysis are pretty well defined, so that it's not easy to do something that's completely disconnected from the decision at hand. So, if a plan does an analysis where they look at a scenario where they have a 25% asset shortfall in 1 year, decline in assets in 1 year, sure, that's academically interesting, and let's hope we never get there, but it's not really that pertinent to the decisions that legislators have to make. And so you have to kind of put a box around what's actually useful, make sure that information gets into the process and in front of legislators.
Yeah, and I'd kind of build on that to say our position, starting with the target audience, is that the target audience should be budget decision makers. And I think this echoes some of the comments that both Josh and Chris made. And the reason for that is those are the people that are going to be responsible for making the hard decisions and planning and better decision making down the road. In terms of who actually produces the analysis, I think that the default setting is probably that the plan and their actuaries and investment experts are responsible for compiling the information. You could say that there's a need for an independent view, and that's fine. But I think from an efficiency perspective, that's where we would start. But we would go to having something in law that sets reasonably clear requirements and is designed for the budget audience, the group that is basically the glue between the plan fiduciaries and the beneficiaries on the one hand, and then the elected officials and the taxpayers on the other side of the ledger from a stakeholder perspective. And so I think that's the balancing act that we think is most important and practical.
And so Greg knows I'm going to say this, but I would draw a broader audience because I think it is ultimately elected officials who are making the budgetary decisions, but they're insulated from much of this risk, and therefore the folks who influence them, financial press, good government groups, ought to be part of the audience as well. I wholly agree. Really, the plans ought to be the first creators of the information, then linked to the budget, and GASB as the standard setter for both the plans and for the governments is in the perfect position. It would be a kind of not quite a do-over, but a chance to make a real improvement by requiring it.
I agree with most of the comments that have been made, but I think the people have argued, and this was alluded to, that some separation might be important. You could have plan staff sort of come up with their own softball scenarios, or you want a little bit of independence there. So either the budgetary staff would be one way of doing that, or an outsider.
Okay. So one thing we didn't talk as much, we focus more on pensions, but how about rainy day funds? Again, this seems to be an area where you could have some sort of a structural change in government, which they'd have to do some sort of scenario where they would try to understand what do they need to get through, say, like a 1 or 2 year event, given certain criteria. So anybody have a position on that? I mean, I know some states have moved a little bit further on that, maybe than on the pension side.
I would like to see states develop their own rainy day reserve that relates only to pensions. And it could be funded from years in which there's excess returns in the investment account. You get 16%, your investment return assumption is 7.25, which may still be too high, but nonetheless, you've had a good year. Some funding and setting aside of additional revenues or matching of revenues to ensure that there's money there.
I don't have anything in particular to say about rainy day funds. I think they're a positive thing. I think that that as it relates to pensions and just the kind of a lot of states have set up rainy day funds. The planning for what you do with the rainy day money and when you can get to it is not complete. And so the same thing occurs with pensions too. We kind of chug along and we don't have an ex ante plan for what we would do. And so decision making gets convoluted and very political. I know that Pew has been working very hard to help states come up with the ex ante plan for when do you dip into your rainy day fund, what things can you do with it, so that there's some kind of constrained decision making. So it's not just, in Texas, we've got a rainy day fund. Do we dip into it for Harvey? Is that enough? Oh, the mayor's a Democrat. Should we wait on the federal funds? I mean, it's a mess right now in a lot of places. I think that on rainy day funds generally and pension plans, I would love to see more defined ex ante plans for what we do in downsides.
And this is tied back to Don's earlier panel. I'll pick this up on volatility, which is some states have also suggested that one way to fund a rainy day fund is to assume that if you have highly volatile revenues, if they overperform, you take that percentage off the top and use it to fund. Would you like to see something more mechanically happen with that if states understand what the underlying volatility is of their revenue structure? Yeah.
Me personally, yes. I mean, I think that, it's always a question of when should formulas make decisions and when should people make decisions? You certainly need overrides. I mean, there are emergencies, right? So it may well be that there are really good reasons for breaking a rule. But yeah, I think that if you're going to have an extraordinarily volatile revenue system, as several states do, it makes sense to have rules that help you establish a culture that says in good times, we're going to, kind of preserve it and put it in the rainy day fund. And it's really got to be raining or we have a good forecast of rain before we take it.
Anybody else want that?
Just to pivot a little bit back to pensions and thinking through how you put these policies in place that are actually actionable. I think Colorado is a terrific example on stress testing and pensions. And taking these big complicated ideas, we've distilled this down to wanting to answer 4 questions. And that has to do with planning for an extended period of lower growth and lower returns, preparing for the next economic downturn where you can model the Dodd-Frank adverse scenarios, for example, managing financial market volatility. And the last one is having a scorecard to evaluate policy options. I bring up Colorado because they did an independent stress test report, which we admired but had nothing to do with. And they actually used that to not only prompt the need for reform, because these were one of the states that were heading down that death spiral of cash flow that Chris talked about, but actually score the reform at the end of the day. So I think as a starting place, we just need policies to be able to make sure we're ready for the next downturn. But I think there's a ways to go in terms of having solid rules that help you make every decision.
Okay, we have 5 minutes left, so I'm going to ask for questions from the audience. Again, just identify yourself and make sure you press your little button. So, thanks.
Hi, I'm Paul Rosensteel. I'm a trustee of CalSTRS, the pension fund in California, so I've been very interested in hearing these comments. First of all, we do stress testing. We've done it 2 years, 3rd year in November, so hopefully, I think it's pretty good. I'd like to see some improvements, but I think it's pretty good. I think we're in a kind of damned if you do, damned if you don't situation running a pension, because if we do the things that improve the funded status, then there's more money that's being taken out of the budget for other things. And so then we get criticized for that. And if we accommodate those needs in the budget, well, then we're not improving the funded status. And so, if you look at CalSTRS, we were in 2009 78% funded. Sounds pretty good compared to today. But we were also, our actuaries said we were headed towards insolvency within 30 years because our funding plan was so insufficient. Since then, we put in place a funding plan. We're now 63% funded, in part because we reduced our discount rate from 7 3/4 to 7%, which increased our unfunded liability. But now with higher contribution rates that the legislature enacted at our request, thankfully, we'll be 100% funded, assuming our assumptions are correct, in 30 years. So I think the message that comes from people like yourselves who are critiquing how pensions are being managed has to has to address this damned if you do, damned if you don't point. And I wonder if anybody has anything to say about that.
I mean, I feel that's part of the deeply flawed system, the fact that in a perfect world, I think a pension plan fiduciary would be a fiduciary guarding the benefits for the retirees, the workers and the retirees. And in fact, you're not in that position. I mean, you may be, no offense intended, you may be a fiduciary, but you're not insulated from the pressures. I don't know the solution to that, but I do think that it's this link between governments and their pension plans is a substantial part of the problem. Another part is the fact that you are rewarded in the short term for taking risk that may harm somebody in the long term. That is, the higher your return assumption, the riskier your assets, the greater the risk that your kids and grandkids are going to be in trouble. But it's not a solution, I guess. Sorry.
I mean, this is one of those political issues where decision-making has been bad, and we find ourselves in the situation we're in, and it's not as if there's a silver bullet out there. And I think that's part of what you're saying. We're talking about how to distribute pain at this point. There's no kind of positive, somebody's going to get off and be great. Hey, Greg can probably talk about this too. You go in and talk to legislators or a governor, and they want to know how to solve it. And by solve it, they mean, how do you make the budgetary pressure go away? And kind of the toughest thing we have to say to them is, you can't. You have to put more money in, or it's going to get much worse in the future, and you're just going to end up having to fill a bigger hole. That's hard. I would echo Don, and I would just put a finer point on it. The decision-making around these systems has not been very good, and that's the thing we have to improve. We have to get incentives going in the right direction. Plan fiduciaries should be fiduciaries, and they should be setting what are adequate contribution levels, and they should be trying to get there. In a lot of places, they, of course, don't have the ability to enforce, but they do have they should have the fiduciary responsibility to say, here's what is adequate. We need to put more pressure on politicians to pay what are adequate contributions, not be able to obfuscate. Right now, there are lots of arguments that allow them to underfund long-term system. Don't worry about it. We're coming out. We've got a plan that will fund us in 40 years. I don't know what. I think Illinois is something like 40 or 50 year funding ramp. We're going to get there. There are lots of people making arguments that let them kind of slip out and not make adequate contributions. We've got to clean up this decision making. I don't think we're going to get there overnight. I don't think the payments are going to be adequate overnight. But we've got to start putting pressure on actors to make better decisions, or we run the risk of these systems blowing up to the detriment of people who participate in them and taxpayers, and that's not a good situation.
So just, I mean,
Can I make a quick remark?
please.
Yeah. Just a quick remark. You probably remember that one of the state of Illinois funds decided to lower their investment return assumption, and the governor was outraged. How could they do this? They're making my costs go up. They're giving me budgetary problems. And yet, in fact, they're engaging in good governance. They have too high of a rate. They need to lower it. They take the appropriate responsible activity, and they lower the rate. And they get heaps of abuse from the highest elected officer in the state, and with no response from anyone. So, it's unfortunate, but someone's going to have to stand up for pension professionals and beat down this kind of commentary, which is incorrect and shouldn't have been made without, an opposing view.
Okay, Don, you can have the last word.
So the scary thing to me is that even if we found, call it $3 trillion to securely fund the liabilities that are out there now with low-risk investments, the system that allowed us to get here is still in place. And so unless that's changed, now everything is bigger relative to budgets that it used to be. So that's to sleep on.
Well, please join me in thanking this terrific panel. We are going to a break, so I know many of you had questions, so you can probably corner any one of these gentlemen and have your questions answered. So thanks again.
Sprinting right away?
Yeah,
pretty much.